Whether you're maybe planning that big overseas trip or just browsing online for some gadget that's shipped from abroad, or even just catching the news headlines about currency ups and downs,
Mm.
there's this one number that always seems to pop up: the exchange rate.
hmm
Why does it matter so much? I mean, why does the value of our money, say the rupee, against another country's money, like the dollar, have such a huge impact, not just on our travel plans, but on the whole economy?
It's uh it's absolutely fundamental, really. That single figure, that exchange rate, it's like the bridge connecting what happens here at home with the entire global marketplace.
Right.
It affects the cost of, well, almost everything from the fuel power in your car to how competitive local businesses are, the ones employing people right here. Understanding it is, I think, key to grasping how global events ripple right into your everyday life.
Exactly. And that's pretty much our mission for this deep dive, isn't it? We want to unpack exchange rates. What are they fundamentally? How do these crucial numbers actually get set? And crucially, what happens when they change, especially for a big, complex, and let's face it, increasingly open economy like India's?
Yeah, we've been digging into some key material on how exchange rates are determined, looking specifically at India's experience and its current setup. Our goal today is really to walk you through that, pull out the important insights, and hopefully help everyone get a better handle on this, well, sometimes complicated world of currency value and its very real effects.
Okay, let's jump right in then. So
Yeah.
starting at square one,
Mm.
what is an exchange rate in simple terms?
Think of it just as the price tag on one country's money when you're buying it with another country's money. It tells you, say, how many rupees you need to get one US dollar, or maybe how many euros you get for your rupees. It's basically the conversion factor for any cross-border transaction.
So like when you see news reports saying USD1 equals 75, or maybe it moves to 78, that number, the 75 or 78, that's the exchange rate we're talking about.
Precisely. That number is the price. And while it sounds straightforward, its importance just balloons when you're talking about economies that are open, economies heavily involved in international trade and investment.
Right, because if you're buying or selling goods across borders or maybe investing money overseas, you constantly hit this need to swap currencies.
Exactly right. If an Indian company wants to import machinery from Germany, they need euros. If a U.S. firm wants to build a factory here in India, they need rupees. The exchange rate is what determines how much it costs them to get that foreign currency. Honestly, without a working exchange rate system, doing business internationally would be, well, incredibly difficult, maybe even impossible.
So logically, the more closed an economy is, the less it trades or invests in internationally, the less that exchange rate number really impacts things domestically.
For the most part, yeah. If an economy is very inward-looking, it runs primarily on its own currency. The need to convert money is minimal, perhaps just for a few vital imports. So the exchange rate still exists, of course, but it doesn't ripple through the domestic economy or drive policy in quite the same way.
And the material we looked at mentioned this kind of extreme case, dollarized economies. That sounds like a whole different situation.
Oh, it is a completely different ballgame. In a truly dollarized economy, the local currency is either barely used or sometimes it's not used at all. Instead, a foreign currency, usually the US dollar, circulates, as the source puts it, parallel and predominantly. It becomes the main currency for everyday transactions.
Wow.
The source mentions these are often smaller economies, heavily dependent on the US. Places like Panama, El Salvador, Ecuador are given as examples.
So they basically hand over control of their currency to another country.
In effect, yes. It means completely giving up your own monetary policy. You can't print your own money. You can't set your own interest rates in the same way. It's a drastic step, usually taken after a total loss of faith in the local currency, perhaps due to hyperinflation. But it really underlines how central a national currency and its exchange rate are to economic independence for most countries.
Okay, so for most open economies that aren't dollarized, how do these crucial exchange rates actually get decided? Is it just like the price of anything else, purely market forces, supply and demand?
That's a great question, and the source is very clear on this. It's not always just the market. While market forces of supply and demand are definitely powerful, central banks often step in and play sometimes a very active role in influencing or even directly setting the rate.
So what are the main ways this happens? How are rates set according to the material?
The source lays out a spectrum, really. At one end, you have what are called pegged or fixed exchange rates. In this system, the central bank doesn't just nudge the rate, it directly determines it and maintains it through constant intervention in the currency market.
Okay, a fixed price set by the bank. Are there different flavors of that?
Yes, the source highlights two important variations. First, there's the currency board. This is a very rigid system. The central bank pegs the home currency to a stronger foreign currency, could be 1-to-1, could be another fixed ratio. The key thing is the amount of domestic currency they can issue is directly tied to how much of that foreign anchor currency they hold in reserve. You can only print more local money if you get more foreign reserves.
That sounds incredibly restrictive.
It is. It enforces strict monetary discipline. That's why it's sometimes considered for countries battling uncontrollable hyperinflation. But the trade-off is huge. The country basically gives up its ability to run an independent monetary policy. They can't adjust interest rates or money supply based purely on what the domestic economy needs. The source mentions Argentina and Hong Kong as examples.
A steep price to pay for stability. What's the other fixed rate approach?
That's usually called a crawling peg, or sometimes just a pegged exchange rate system. It's similar because the central bank sets the rate, but it allows a little bit of wiggle room. The rate can fluctuate, but only within a narrow, predefined band. There's a ceiling and a floor. The central bank intervenes only if the rate tries to breach that band. The source points to countries like China and Russia as examples using this kind of setup.
So a bit more flexibility than a currency board. What's on the complete opposite end of the spectrum?
That would be the market-determined exchange rate, often called a full float or free float. Here, in theory, the central bank steps back entirely from setting the rate. The exchange rate is purely the result of the overall supply of foreign currency coming into the country, meeting the overall demand for foreign currency from within the country. Market forces rule. The source cites the US and the Eurozone as examples of economies with fully floating rates.
And then there's this middle ground, which seems to be where India fits in, according to the source.
Exactly. This is often called the managed exchange rate system. Sometimes you might hear it called dirty floating, though that sounds a bit negative.
Yeah.
The idea here is that the exchange rate is fundamentally driven by market forces. Supply and demand are the main game. However, the central bank isn't just a passive observer. It actively intervenes in the market, usually indirectly, to influence where the rate settles. The goal is often to guide the rate towards a level the bank thinks is better for the economy, but without committing to a strict, publicly announced fixed peg.
And the source really emphasizes why India's system gets called managed.
Yes, it's managed precisely because the Reserve Bank of India's interventions are driven by how exchange rate movements are expected to impact the domestic economy, things like exports, imports, inflation, financial stability. That makes the RBI a really significant player shaping market dynamics, even if it's not strictly fixing the rate.
That distinction between systems is really important. The source also brings up this idea of hard versus soft currencies. How does that classification fit in?
It's another layer, really, about the global role and usability of a currency. Hard currencies, according to the source, are typically from countries with huge shares in global trade. They usually have market-determined exchange rates and are widely accepted across the globe for all sorts of transactions. Think US dollar, the euro, British pound, Japanese yen. Those are the classic examples.
Okay, and soft currencies are, well, the opposite, less accepted globally.
Pretty much. Soft currencies are generally linked to economies with a smaller global trade footprint. Their exchange rates might have more restrictions or controls, and crucially, they aren't as easily or widely accepted for international payments or investments. The source puts the Indian rupee and also the Chinese yuan, to some extent, into this category in the current global system. It just highlights the practical reality that not all currencies carry the same weight or convenience in international finance.
Okay, so we've got the different systems for setting the rate, but the source makes a really strong point about not confusing this with convertibility. Just people often mix these up.
Yes, this is a critical distinction they flag. The source stresses that exchange rate determination, which is about how the price is set, fixed, floating, managed, is a totally separate issue from convertibility. Convertibility is about how freely you can actually exchange your home currency for foreign currency for different purposes, like importing goods, investing abroad, or even just taking money on holiday. These are separate policy choices a country makes.
And the evidence is that you see all sorts of combinations in the real world.
Exactly. The source walks through the different possibilities to show they don't automatically go together. You can have a full float with full convertibility, like the US.
Right.
You can have a pegged rate, but still have full convertibility, like Thailand. You can have a pegged rate and very limited convertibility, especially on the capital account. China is the example given.
Okay.
You can have currency boards with full convertibility, as Argentina did. Then you have India's case. a managed rate with limited convertibility, particularly restrictions on capital outflows, often termed no capital account convertibility, or CAC. And finally, you could have a managed rate, but with complete convertibility, like Brazil.
So how the price is set doesn't dictate how freely you can actually swap the money for different uses abroad. Those are two different decisions a government makes.
Precisely. They're distinct policy levers. But, and this is important, the source notes that both the exchange rate system and the degree of convertibility heavily influence capital flows, money moving in and out of the country. And it's often the interplay between these especially large, sudden capital movements that has been linked to financial crises in open economies. The Southeast Asian crisis in the late 90s is often cited as a prime example of this danger.
Right. Speaking of India, let's trace its own story here, because the source provides a really neat overview of how India's approach to the exchange rate has changed over time. It wasn't always this managed float.
Oh, absolutely not. India's exchange rate journey really mirrors its broader economic opening up. Right after independence, India started with a very straightforward fixed exchange rate. The rupee was pegged directly to the British pound sterling, and the Reserve Bank of India, the RBI, simply decided what that rate was.
And back then, the economy was pretty close, right? So it didn't matter as much day to day.
Exactly. As the source points out, India was a relatively closed economy then, so that fixed rate didn't have the kind of widespread impact on daily life or business decisions that it does now.
What happened as India started trading a bit more with other countries?
As India's trade partners slowly diversified beyond just the UK, even though trade itself was still quite restricted, the RBI shifted the peg. Instead of just the pound, they started pegging the rupee to a basket of currencies of its major trading partners. But critically, it was still a fixed system. The RBI determined the rate against this basket.
And then the U.S. dollar became dominant globally. How did India adapt?
Yes, as the USD rose to prominence, becoming the world's main currency for trade and finance, the RBI adapted again. The USD became India's official intervention and reserve currency. This meant the RBI held most of its foreign currency reserves in dollars. It used dollars when it needed to intervene in the market, even under the fixed system. And the official rates for all other foreign currencies were calculated based on their value against the dollar, and then derived from the USD rupee rate.
The really big change, though, came with the economic liberalization reforms in the early 1990s. That must have shaken things up.
Absolutely. That was the turning point. It marked the first real move away from the purely fixed system India had known since independence. They introduced something called the Liberalized Exchange Rate Management System, or LERMS.
LERMS, okay. What did that involve?
It was essentially a dual exchange rate system. For 30% of foreign currency earnings, mainly from exports and remittances, businesses had to convert them into rupees at a fixed official rate set by the RBI.
And the remaining 60%.
The other 60% could be converted at a market rate. And, significantly, for the first time, an organization outside the government, the Foreign Exchange Dealers Association of India, FEDAI, basically an association of banks dealing in Forex, was tasked with determining this market rate based on actual supply and demand conditions in the interbank market.
Interesting. So one foot still in the fixed world, one stepping into the market world.
Pretty much. A transitional phase. But this dual system didn't last all that long. By the late 1990s, the RBI completely discontinued the official fixed rate. From then on, only the market rate determined by FEDAI was operational. This marked the complete shift away from the historical fixed exchange rate regime.
And that directly led into the managed system we have today.
Exactly. The source explains that as the economic reforms continued over the following decade or so, leading up to when the text was written, they resulted in significantly larger capital inflows into India. Faced with these large flows, the RBI found it couldn't just sit back and let the market rate go wherever it wanted. It started intervening more actively to manage the impact of these flows on inflation, exports, and the overall economy. And that regular intervention in what is fundamentally a market-determined system is what defines the current managed exchange rate regime.
It's fascinating to see that evolution. So under this managed system, the starting point is still the market supply and demand. Let's dig into how that actually works, even with the RBI potentially stepping in. It boils down to who wants foreign currency and who's supplying it.
Right. Fundamentally, yes. It's like setting the price for anything. The exchange rate finds its level where the total amount of foreign currency people in India want to buy meets the total amount of foreign currency flowing into India that people want to sell.
Okay, let's break that down. Who are the main players demanding foreign currency? Let's use U.S. dollars as the main example within India. Who needs to buy dollars?
The source lists the key groups. You've got importers, obviously, needing dollars to pay for goods and services they bring in from abroad.
Sure.
Then you have Indians traveling overseas as tourists. Businesses conducting sales promotions or setting up offices abroad need dollars. The government itself has foreign currency needs for various payments. And of course, individuals going abroad for education or medical treatment. So there's this constant ongoing demand for dollars for a whole range of reasons.
And presumably, the demand reacts to the price. Like if the dollar gets really expensive in rupee terms, people might demand a bit less, maybe put off that holiday.
Exactly. There's usually an inverse relationship. If the exchange rate weakens, meaning you need more rupees to buy $1, say 80 instead of 75, that dollar feels more expensive. Demand for non-essential things like tourism or perhaps some types of imports might decrease. Conversely, if the dollar gets cheaper, rupee strengthens, say to 70, demand might pick up. It's that typical downward sloping demand relationship.
Okay, that's the demand side. Where does the supply of foreign currency, the dollars flowing into India, come from? Who's selling dollars and wanting rupees?
Again, the source highlights several key sources providing a continuous stream. A really big one for India is remittances money sent home by the huge number of Indians working abroad, NRIs. Foreign investment is another major source. This includes both long-term foreign direct investment, FDI, like building factories or infrastructure, and also foreign portfolio investment, FPI, which is investment in Indian stocks and bonds. This used to be called FII.
Okay.
Then you have NRI deposits in Indian banks, Indian companies borrowing money abroad through external commercial borrowings, ECBs, bring in dollars. And finally, inward tourism, foreign visitors spending their currency here. So there's a constant supply side too.
And for these suppliers, the incentive works the other way compared to demanders. The weaker the rupee is, meaning the more rupees they get for each dollar they bring in, the more dollars they're likely to supply.
Precisely. If you're holding dollars and the exchange rate shifts so you get, say, 80 per dollar instead of 75, you have a greater incentive to convert those dollars into rupees now. So generally, as the price of the dollar in rupees goes up, rupee weakens, the quantity of dollars supplied tends to increase. That gives you the upward sloping supply relationship.
So the basic market exchange rate, before we even consider any RBI management, is just where these two forces meet, where the demand curve intersects the supply curve.
That's the fundamental mechanism. It's the rate that balances the market where the quantity of dollars demanded exactly equals the quantity supplied. The source uses a hypothetical example. Maybe at an exchange rate of USD1 equals 40, demand perfectly matches supply. That euro becomes the market clearing rate in that scenario.
And what happens if one of these forces shifts? Say, there's a sudden big wave of foreign investment coming into India, more supply.
Right. The source explains this well. If there's a surge in inflows, like a lot more FDI or maybe a jump in remittances, it means that at any given exchange rate, there's suddenly more supply of dollars available than before.
Okay.
Visually, that supply curve shifts outwards to the right. Now, with more dollars washing around and demand staying the same, the price needed to clear the market will fall. The exchange rate will move maybe from that hypothetical USD1 down to, say, USD1 equals 38.
Right. And these movements have specific names. When the rate goes from 40 euro needed for a dollar down to only 38, what do we call that change for the rupee?
Using that example, 40 down to 38 per dollar, when you need fewer rupees to buy $1, or looking at it the other way, the same number of rupees now buys more dollars than before, the source defines this as rupee appreciation. The rupee has gotten stronger relative to the dollar.
Okay, the rupee appreciates. What's happening to the dollar in that same scenario?
At the exact same time, the dollar is now getting fewer rupees than it did before, only 38 instead of 40. To get the same amount of rupees, you'd now need slightly more dollars. This is termed dollar depreciation against the rupee. It's absolutely crucial to remember this relativity. If one currency appreciates against another, the other currency must depreciate against the first. There are two sides of the same coin.
Got it. So appreciation means the rupee strengthens, need fewer rupees per dollar. What about the opposite scenario when the rupee gets weaker?
That's rupee depreciation. Let's say the rate moves the other way. From USD1 yield 40 up to USD1 equals 42. Now you need more rupees to get that same $1. Or your rupees buy lesser dollars than they did before. This means the rupee has become weaker against the dollar.
And in that case, the dollar has appreciated against the rupee.
Exactly. The dollar is now fetching more rupees than it was earlier. You need lesser dollars to get the same amount of rupees. So the dollar has appreciated against the rupee. If you think back to our supply and demand graph, this would happen if the supply of dollars coming into India decreased, supply curve shifts inwards, or if the demand for dollars within India increased, demand curve shifts outwards. Either way, the intersection point moves up to a higher exchange rate, meaning more rupees are needed per dollar.
Okay, so appreciation and depreciation. These aren't just numbers changing on a screen, are they? They have really significant consequences for the real economy, and the source really digs into these impacts. Let's start with the effects of appreciation when the rupee gets stronger, like going from 40 to 38 per dollar.
Yes, and this is where the whole managed aspect of India's system really comes into play. When the rupee appreciates, think about someone outside India wanting to buy Indian goods or services. If their dollar now buys fewer rupees, only 38 instead of 40, that Indian product priced in rupees suddenly looks more expensive to them in dollar terms.
Ah, right.
This directly impacts the price competitiveness of India's exports on the global stage. The source says this adversely hits exports. It makes it harder for Indian companies to sell their products abroad based on price.
But on the other hand, surely it makes imports cheaper for people in India.
Absolutely. That's the flip side. If the rupee is stronger, you need fewer rupees to buy the dollars or euros or yen needed to pay for imported goods. So imports become less expensive in rupee terms.
And what does that combination, more expensive exports, cheaper imports, do to the overall trade balance, the current account deficit?
Well, if exports become less competitive and imports become cheaper and potentially increase, the gap between the value of imports and the value of exports tends to widen. This can cause the current account deficit, say, to balloon, as the source puts it.
So this pressure on exports and the risk of a bigger CAD, is that a major reason why the RBI might step in and intervene when the rupee is appreciating strongly in this managed system?
That's exactly it. Preventing the rupee from appreciating too much or too quickly, primarily to protect the competitiveness of exports and keep the CAD from getting out of control, is often cited as a key motivation behind the RBI's interventions in the currency market.
Okay, so how do they actually do that? If the market is pushing the rupee stronger,
Yeah.
fewer rupees per dollar, how does the RBI fight that trend?
The main tool described in the source is for the RBI to enter the market and actively buy U.S. dollars. By creating this additional demand for dollars, the RBI essentially mops up the excess supply of dollars that was causing the rupee to appreciate. This action helps to push the exchange rate back down, weakening the rupee relative to the dollar, or at least slowing its appreciation.
But wait a minute. If the RBI is buying billions of dollars, they have to be paying for them with rupees, right? Doesn't that flood the Indian banking system with extra rupees?
It absolutely does, and that's the crucial side effect. Every time the RBI buys foreign currency, it injects an equivalent amount of rupees into the domestic financial system. This increases the money supply, boosts liquidity, and carries a significant risk of fueling domestic inflation. So the very act of intervening to help exporters by managing the exchange rate can inadvertently create inflationary pressures at home.
Oof, that sounds tricky. Is there anything they can do to stop that inflationary impact?
Yes, there is a technique called sterilization. The idea is that the RBI tries to counteract or sterilize the inflationary effect of the rupees it just injected. They do this by simultaneously using other tools to pull those excess rupees back out of the system.
Oh.
They might conduct reverse repo options, where they essentially borrow money from commercial banks, effectively locking up those rupees. Or they might sell government bonds from their holdings, which also absorbs liquidity from the banks buying them. The goal is to neutralize the impact on the overall money supply.
And if they manage to soak up all the extra rupees perfectly?
If the RBI successfully sterilizes the intervention, meaning they fully absorb the excess liquidity so that domestic inflation isn't affected, then the intervention is considered sterilized. But the source notes, perfect sterilization is often very difficult to achieve in practice.
Why is that?
Well, the scale can be huge, and mopping up liquidity can have other effects, like pushing up short-term interest rates, which might attract even more capital inflows, partially defeating the purpose. The source highlights that if sterilization isn't complete, the RBI faces this tough choice, almost like a prisoner's dilemma. Do they prioritize helping exporters by keeping the rupee from appreciating, or do they prioritize controlling domestic inflation? It becomes very hard to achieve both perfectly at the same time when you're fighting strong market currents.
Are there other ways they might try to manage these appreciation pressures from large inflows?
The source briefly mentions ideas like discouraging certain types of short-term capital inflows, perhaps through taxes, like a Tobin tax on financial transactions. However, it quickly points out a major practical problem. These kinds of measures often end up being blunt instruments. It's very hard to design them, so they only hit speculative hot money without also discouraging desirable long-term investment like FDI. They tend to be non-discretionary and hit all inflows.
Given all these complications, the inflationary side effects, the difficulty of sterilization, the prisoner's dilemma, the force seems to raise a fundamental question. Is this constant intervention to stop the rupee appreciating really the best approach in what's supposed to be a market-driven system?
Yes, this is a really core critique presented in the material. The argument is that in a market-based system, the exchange rate is supposed to be a flexible price signal. It's meant to adjust based on underlying economic conditions. The economy should, ideally, be adaptable enough to handle these fluctuations, these waves, as the source puts it.
So the exchange rate should be seen more broadly.
The source suggests viewing the exchange rate as a macroeconomic tool, something that affects and should ideally benefit the entire economy, not just as a myopic instrument for micromanaging one specific sector like exports. Exports are important, yes, but the source reminds us they only constituted about 20% of India's GDP at the time. Focusing intervention solely on their price competitiveness might be missing the bigger picture.
And what's being missed? Is there a positive side to appreciation that gets overlooked?
Absolutely. The source highlights a crucial benefit. A stronger rupee makes essential imports cheaper. Things India has to buy from abroad, like crude oil, fertilizers, vital machinery, and capital goods. These all become less expensive in rupee terms when the rupee appreciates. This acts as a valuable buffer against inflation, which is often a major headache for the Indian economy.
And the argument about export competitiveness, the source suggests it shouldn't just be about price anyway.
Exactly. This is another strong point made. True, long-term export success shouldn't hinge solely on having a weak currency. Sustainable growth in exports comes from adding value, improving quality, adapting to changing global demands, having efficient logistics, and building overall industrial capacity. The source argues that exporters need to learn to manage the inevitable volatility of market-determined exchange rates rather than relying on the central bank to artificially maintain a favorable rate for them.
Diversifying where India exports to is also mentioned as a strategy.
Yes, briefly. The idea is floated that focusing more on non-dollar markets, perhaps in Africa and Asia where other payment mechanisms might exist, or where competitors face similar currency issues, could reduce the sensitivity of Indian exports purely to the USD rupee rate.
And maybe, just maybe, a strengthening rupee over the long haul isn't such a bad sign.
The source does suggest that perspective. An appreciating rupee, particularly if it's strengthening against major hard currencies like the dollar, can be interpreted as a positive signal reflecting improving underlying economic fundamentals and competitiveness over the longer term.
You know, listening to all this, the difficulty of managing appreciation, the trade-offs, the potential harm of intervention, the debate about whether exports need a weak rupee,
Yeah.
it almost makes you think, as this source seems to imply, maybe sticking with a more controlled or pegged system, like China's perhaps, would have been less stressful if managing market volatility is proving this hard for India.
It's a provocative question the source definitely leads you to consider. If the economy isn't fully equipped to handle the waves of a floating rate, and if certain sectors are perceived as needing constant protection via the exchange rate, then was a move to a market-determined system, with all its inherent volatility, truly the optimal path? It forces a reevaluation.
But the source doesn't argue against all intervention, does it? It suggests there are times when it is justified, even in a managed float system.
No, it's not a call for pure laissez-faire. The source concludes that intervention should be seen as a tool of last resort, reserved for exceptional circumstances. Specifically, when you have massive capital inflows that are clearly short-term and reversible, think speculative portfolio flows or hot money driven perhaps by global imbalances rather than domestic fundamentals, and these flows are demonstrably destabilizing the domestic economy, maybe by creating asset price bubbles or fueling rampant speculation. In those specific, severe cases, stepping in to maintain financial stability might be warranted.
And what happens if lots of countries start intervening like this around the same time?
That's the slippery slope towards currency wars. When multiple countries, especially emerging markets, flooded with capital, simultaneously try to suppress their currency's appreciation to protect their exports, it leads to competitive interventions or even deliberate devaluations. The source points to a period in the late 2010s involving countries like Brazil, South Korea, Russia, and Japan engaging in such practices.
And the verdict on these currency wars? Not good.
Definitely not. The source calls them self-destructive. They distort global trade patterns, create huge uncertainty for businesses, and often provoke retaliatory protectionist measures from other countries. It's a race to the bottom. The source actually credits India for taking a relatively restrained stance during that period, largely refraining from aggressive intervention and cautioning other nations against pursuing such beggar-thy-neighbor policies.
So, looping back to exports one last time, the source's ultimate message seems pretty clear. Stop relying on a cheap currency as a crutch.
Absolutely. It's quite blunt. Export growth shouldn't piggyback on the exchange rate in the long run. The focus needs to shift decisively towards improving fundamental competitiveness, value addition, quality upgrade, supply chain efficiency, innovation so that exports become more resilient and less sensitive to inevitable currency fluctuations. Price helps, but it can't be the only strategy.
Okay, we've thoroughly covered the impact of appreciation. Let's flip the coin now and talk about the impact of depreciation when the rupee gets weaker, like going from 40 euro up to 42 for a dollar.
Right. So depreciation happens when the demand for dollars exceeds the supply, maybe because capital is flowing out or inflows have dried up or import demand is very high. More rupees are needed to buy each dollar.
What does that do to exports and imports, theoretically?
Well, the textbook theory is that depreciation should help exports. Indian goods, priced in rupees, become cheaper for foreign buyers because their dollars now buy more rupees. So theoretically, exports should become more competitive and volumes might increase. And imports. They become more expensive. You need more rupees to buy the foreign currency needed to pay for imported goods. So again, theoretically, this should discourage imports.
Which sounds like it should be good for the current account deficit, right? Exports up, imports down, that should narrow the gap between what we earn from abroad and what we spend.
That's the standard theory, yes. But the source makes a really crucial point specifically about India's situation. A very large chunk of India's import bill consists of things considered essential, crude oil being the prime example, but also fertilizer, certain types of machinery, maybe some essential foodstuffs.
Ah, okay. So even if imports become more expensive, India still has to buy roughly the same amount of these essential things.
Exactly. The demand for essentials like oil is relatively inelastic to price in the short term. You still need fuel for transport, power plants, industry. So while the volume of essential imports might not fall much, the value of those imports in rupee terms shoots up significantly because of the weaker rupee.
So paradoxically, depreciation could actually worsen the CAD for India.
It can, yes. If the increased cost of essential imports outweighs the potential gains from cheaper exports, the CAD can actually widen. And this links directly to the major fear associated with depreciation in India, importing inflation. When the cost of essential inputs like crude oil rises sharply due to a weaker rupee, it feeds directly into higher domestic prices for fuel, electricity, transportation, and eventually almost everything else.
Wow. So despite the potential export boost, depreciation isn't generally seen as a desirable path or a good strategy for export promotion in the Indian context.
Generally not, according to the source, mainly because these negative consequences worsening the CAD due to expensive essential imports and fueling domestic inflation are seen as outweighing the potential benefits for exporters.
And if the rupee keeps depreciating continuously in market system, that can become a really serious problem, can it?
Oh, absolutely. Persistent, sharp depreciation can erode confidence in the currency, both at home and abroad. People might start trying to convert their rupees into dollars or other foreign currencies, which further fuels the depreciation. This kind of downward spiral can lead to a full-blown currency crisis or even a free fall, making economic management incredibly difficult.
How would the central bank, the RBI, try to stop a depreciation spiral in a market-based system?
In this situation, the RBI would typically do the opposite of what it does during appreciation. It would intervene by selling U.S. dollars from its foreign exchange reserves into the market. By increasing the supply of dollars available, they aim to push the price of the dollar back down relative to the rupee, thereby supporting the rupee's value and counteracting the depreciation pressure.
And just like buying dollars injects rupees and risks inflation, selling dollars must have the opposite effect on the domestic economy.
Yes, exactly. When the RBI sells dollars, it receives rupees from the banks buying those dollars. This effectively sucks rupees out of the domestic banking system, reducing liquidity and tightening monetary conditions. This can have a contractionary effect, potentially slowing down the economy and even risking a slide towards recession if credit becomes too tight or expensive.
So to prevent that, they might need to loosen monetary policy at the same time.
Correct. They might need to simultaneously implement expansionary monetary policies like cutting interest rates or injecting liquidity through other means to offset the tightening effect caused by selling dollars. It becomes a complex balancing act.
The source mentioned the Southeast Asian crises again here, didn't it? As a warning.
Yes, it serves as a cautionary tale. During those crises in the late 90s, some central banks aggressively sold their foreign reserves, trying to defend their currencies from depreciation. But in some cases, this backfired. Seeing reserves dwindle rapidly was interpreted by markets as a sign of weakness or desperation, which actually accelerated capital flight and worsened the depreciation. It highlights the risks and limitations of intervention, especially when market sentiment is strongly negative. Central banks and market systems watch continuous depreciation very, very nervously.
This leads perfectly into another key distinction the source emphasizes: the difference between depreciation and devaluation. They sound alike, but they happen under different systems, right?
Exactly. It's a crucial difference in terminology and meaning. We've established that depreciation is what happens to a currency under a market-determined or flexible exchange rate system. It's the outcome of market forces shifts in supply and demand, like capital flowing out, reduced inflows, or high import demand, causing the currency to weaken naturally.
Okay, market outcome. What about devaluation then?
Devaluation specifically refers to an action taken under a fixed or pegged exchange rate system. It is a deliberate, official policy decision by the central bank or government to change the fixed parity. They formally announce that they are setting a new, weaker exchange rate, essentially offering more units of the home currency for 1 unit of the foreign anchor currency than before.
So India actually used devaluation back when it operated under a fixed rate system.
Yes, the source reminds us of this. India resorted to devaluation as an official policy tool in the late 1960s, and again, quite significantly, in the early 1990s, just before the major reforms. The main objective then was usually to tackle severe balance of payments problems by making exports suddenly cheaper and imports suddenly more expensive, hoping to curb the trade deficit. The 1991 devaluation was also seen as a step towards preparing the economy for a more market-based exchange rate.
So the absolute key takeaway: devaluation is a policy choice made by authorities under a fixed system. Depreciation is what happens in the market under a flexible system.
Precisely. One is a government decree, the other is a market result.
Okay, now let's focus specifically on the period the source discusses, where the Indian rupee faced that really steep depreciation. Why did it fall so hard and so fast?
Yeah, the source points out that after India moved fully to market-determined rates around 1999, the general trend for the rupee was actually towards depreciation over the long run. And it highlights periods where this became particularly sharp, hitting record lows, breaching 68 to the dollar at one point, from the perspective of the text, which was a major psychological barrier.
And it contrasts this with the very early days, pre-independence, when the rate was notionally 1.1.
Right. It mentions that historical context 1.1 pre-independence, then about USD1 equals 5 right after independence. But it's crucial to remember, as we discuss, that was under a completely different regime, fixed rate, closed economy. That number didn't reflect global competitiveness or market forces in the way today's rate does.
The devaluations came later, as India faced economic difficulties.
Exactly. The source notes that due to mounting challenges, rapid population growth, sluggish economic growth, high inflation, and critically, a persistent structural trade deficit where imports consistently outstrip export earnings. India had to resort to those official devaluations several times after 1966 just to try and keep the external accounts somewhat balanced. Difficulty earning enough foreign exchange was a long-running theme.
So shifting to a market-based rate in 1999 meant that these underlying pressures would now manifest as natural exchange rate movements, as volatility.
That's the idea. In a market system, the rate is expected to adjust based on all these factors: the current account balance, capital flows, interest rate differentials, global sentiment. These movements are the waves the source talks about. The expectation, or perhaps hope, was that the economy would become resilient enough to handle this volatility.
But the source argues that the fall, especially the sharp drops around 2013 and again noted in late 2016, was more severe than just natural waves. What were the specific reasons for that steep slide?
The source is quite clear. The sharp depreciation wasn't the root cause. It was a symptom reflecting several underlying vulnerabilities being exposed. The first, and arguably the most significant structural factor, was India's chronic and high current account deficit, CAD.
The import-export gap again.
Yes. Consistently spending more foreign currency on imports than earned through exports means there's a built-in, persistent excess demand for dollars. This naturally puts downward pressure on the rupee. The source notes this deficit was particularly exacerbated during the period by high global prices for two key imports, crude oil and gold.
And the source mentioned a dangerous feedback loop here.
It did. When the rupee starts to weaken because of the CAD, it makes those essential imports like oil even more expensive in rupee terms. This, in turn, can widen the CAD further, creating even more downward pressure on the rupee. The source termed this risk a harder landing scenario. The problem feeds on itself.
Now, for many years, wasn't this CAD covered by money flowing into India through investments?
That's right. For a long time, leading up to roughly late 2012 or early 2013, according to the source's timeline, India received sufficient capital inflows, a mix of FDI, FPI, NRI deposits, ECBs, to finance the CAD. This inflow essentially offset the deficit in the current account, which helped keep the exchange rate relatively stable, or at least the volatility manageable. The waves weren't too turbulent.
But the type of capital flow mattered. The source seemed critical of the mix.
Yes, this was identified as a major vulnerability. India's capital account relied quite heavily on flows that are known to be more volatile and easily reversible. Specifically, FPI, portfolio investments in stocks and bonds, and certain types of NRI deposits are much quicker to flow out during times of global uncertainty compared to FDI, direct investment in businesses and infrastructure, which tends to be more stable and long-term.
So when global conditions change, these reversible flows headed for the exit.
Exactly. When adverse global events occur or sentiment shifts, this hot money can leave very quickly. This sudden outflow exposes the underlying current account deficit, disrupts the supply-demand balance for dollars dramatically, and triggers sharp depreciation.
And the big trigger, identified in the source, starting around May 2013, was related to the U.S. Federal Reserve.
Precisely. The main catalyst for the sharp depreciation kicking off in May 2013 was the U.S. Federal Reserve signaling and then beginning the tapering of its quantitative easing QE program. QE had pumped huge amounts of liquidity dollars into the global system after the 2008 crisis. The signal that this fire hose of easy money was being turned off meant less global dollar supply, and it prompted a major shift in capital flows away from emerging markets like India back towards developed economies, especially the U.S.
And the U.S. economy itself was looking better.
Yes, signs of economic recovery were strengthening in the U.S., which made U.S. assets, particularly stocks, look more attractive to international investors. This provided a pull factor, complementing the push factor from the QE tapering signal.
So portfolio investors started pulling money out of the Indian market.
Massively. The source highlights FPI outflows averaging around USD $6 billion per month, starting from May 2013. This huge withdrawal of funds severely reduced the supply of dollars available in the Indian market, creating intense pressure and causing the rupee to depreciate sharply.
The source also gives that later snapshot from November 2016. What happened then?
Yes, it notes the rupee hitting another significant low point, a 39-month low at the time, shortly after India's demonetization policy was announced. This coincided with substantial outflows by foreign institutional investors, FIIs, the older term for FPIs, about USD $5 billion from equity and debt markets in that period.
And what drove those outflows in late 2016?
The source links them primarily to market expectations of an impending interest rate hike by the U.S. Fed, anticipated in mid-December that year, which tends to draw capital towards the U.S. Additionally, there was speculation about the potential impact of protectionist policies under the newly elected U.S. president on emerging markets, creating uncertainty.
So it seems it was this combination, the underlying structural weakness, CAD, the reliance on volatile flows, and then specific global triggers, U.S. monetary policy shifts, political uncertainty, that caused these periods of steep decline. And presumably, speculation made it worse.
Oh, undoubtedly. Once a currency starts falling sharply, the expectation that it will continue to fall can become self-fulfilling. Speculators jump in, betting on further depreciation. The source specifically mentions the role of offshore speculation through instruments called non-deliverable forwards, NDFs, traded mainly in places like Singapore and Dubai. These are essentially bets on the future USD INR rate, conducted outside India and beyond the direct control of the RBI, adding another layer of speculative pressure.
Right. This really brings us to the wider consequences of such a sharp rupee depreciation. We touched on some, but let's recap the deeper implications for the economy and for people in India.
The source details several quite serious impacts. The most direct hit for the average person is imported inflation. As we discussed, when the rupee weakens significantly, the cost of essential imports, crude oil, machinery, fertilizers, edible oils, shoots up in rupee terms. This higher cost gets passed through, contributing significantly to overall domestic inflation, which the source notes has often been stubborn and sticky in India, making everyday life more expensive.
And it goes beyond just consumer prices.
Yes. The higher cost of imported raw materials and capital goods increases production costs for businesses across the board. This puts pressure on their margins or forces them to raise their own prices, adding to the inflationary cycle.
What about the general mood, investment, and overall economic growth?
A rapidly depreciating currency often creates a climate of negative sentiment and uncertainty. It can make businesses hesitant to make new investments, especially if they rely on imported components or face global competition. Consumers might also become more cautious and cut back on spending. This combination acts as a drag on overall economic growth.
And the stock market usually reacts negatively too.
Yes, the same capital outflows, like FPI selling shares, that contribute to the depreciation directly pull down the stock market indices. While daily stock market movements don't affect everyone directly, a falling market reflects and reinforces the overall negative economic sentiment.
And that chronic CAD problem we keep mentioning, depreciation, makes it harder to manage and puts the country's foreign exchange reserves at risk.
Absolutely. As we saw, depreciation can worsen the CAD by increasing the value of essential imports. Financing this larger deficit requires drawing down the nation's foreign exchange reserves. The source explicitly raises the concern that if the deficit persists and reserves deplete rapidly, reserves that previously seemed relatively adequate can quickly become inadequate. It evokes the memory of the 1991 balance of payments crisis, a very serious situation where India's reserves were dangerously low, forcing the country to pledge its gold reserves and seek an emergency loan from the IMF.
That sounds like a scenario that could really shake confidence in the currency itself.
It does. The source mentions genuine concerns arising during these periods about domestic faith in the rupee eroding. If people lose confidence, they might try to shift their savings into foreign currency or gold, which would only worsen the depreciation. This, combined with the widening deficit and falling reserves, raises the real fear of a full-blown currency crisis.
And that theoretical benefit for exports making them cheaper, did the source suggest it actually provided a major boost during these sharp depreciations?
The assessment seems to be that the benefit was limited. While depreciation technically makes exports cheaper, the source implies that for India, the positive impact wasn't as strong as theory might suggest. This is partly because, as discussed earlier, export competitiveness depends on many factors beyond just price, like quality, reliability, logistics. The steep depreciation essentially tested how price-sensitive Indian exports really were, and the conclusion seems to be, perhaps not sensitive enough for the benefits to outweigh the significant downsides.
Okay, so the implications were pretty widespread and worrying. What about the measures taken at the time to try and stop the rupee's slide? The source mentions some, but were they effective?
The source lists several measures that were reportedly tried or considered during those periods of high volatility. Things like restricting outward remittances by individuals under the Liberalized Remittance Scheme, LRS, floating ideas about special NRI bonds to attract dollar deposits, direct market intervention by the RBI selling dollars from its reserves, and potentially using monetary policy tools like hiking the repo rate to make rupee assets more attractive for debt investors.
And what was the source's assessment of how well these worked?
The verdict presented in the source is pretty clear. These measures have been unable to check the extreme rupee volatility. They essentially failed to stem the tide or fundamentally fix the underlying problem.
Why did they fail, according to the analysis?
This is where the source offers a really critical diagnosis. It argues that most of these measures fundamentally misdiagnosed the problem. They treated the symptom, the falling rupee, as the disease itself, and they primarily tried to address it by suppressing the demand for dollars, like limiting remittances, or providing temporary artificial supplies, selling reserves.
But the real issue was elsewhere.
Exactly. The source argues the core issue wasn't excessive demand, but rather a fundamental lack of adequate supply of foreign currency coming into India on a sustained basis relative to the economy's structural demand, driven by imports and the HAD. Trying to fix a deep-seated supply problem by just squeezing demand here and there is described as being like squeezing a balloon. The pressure just bulges out somewhere else. It doesn't solve the underlying imbalance. It was, in the source's view, the wrong diagnosis leading to ineffective treatment.
So if suppressing demand was the wrong approach, the right approach must be focused on increasing the supply of foreign currency coming into India.
Absolutely. That's the core prescription offered by the source. The most effective and sustainable way to stabilize the rupee and address the underlying imbalance is to focus on policies aimed at augmenting the supply of US dollars and other foreign currencies flowing into the Indian economy. If supply can be boosted to meet or exceed the structural demand, the pressure for depreciation naturally eases.
Okay, what are the specific concrete ways suggested to actually boost that supply?
The source highlights aggressively pushing exports as the first step and describes the situation of a depreciated rupee as a rare opportunity to do so because it makes Indian goods relatively cheap globally.
How to push exports.
It calls for practical measures, removing infrastructure bottlenecks, providing better logistics support, cutting bureaucratic red tapeism in export-related departments to ensure faster clearances, and mandating banks to provide more liberal and accessible funding for exporters. The emphasis is on a quick response from both the government and exporters themselves to capitalize on any potential recovery in global markets, like the US and Eurozone mentioned.
Makes sense. What else contributes to the supply of dollars?
Attracting more foreign direct investment, FDI, is highlighted as absolutely crucial. The source strongly favors FDI because it's generally seen as stable, long-term capital that brings technology and expertise, unlike the more volatile FPI.
And how to attract more FDI?
Recommendations include fast-tracking pending FDI proposals stuck in the approval process, mentioning the Foreign Investment Promotion Board, FIPB, and further liberalizing FDI regulations to open up more sectors or increase ownership limits. But it also connects attracting FDI to the broader goal of getting India back onto a high-growth trajectory. This requires boosting overall investment, including clearing bureaucratic hurdles that hold back domestic private investment and government projects. The call is for quick reforms, maybe not always radical, but certainly swiftly implemented changes to improve the investment climate.
Okay, boosting exports and FDI increases supply. Does managing the demand side have any role?
Yes. While criticizing demand suppression as the primary strategy, the source does acknowledge that managing demand is also part of the equation. It notes that the government had already taken some positive steps in restricting non-essential imports, which directly helps by reducing the outflow of dollars.
What about where India buys its imports from?
That's another suggestion. Diversify import sources. The idea is to actively seek opportunities to import more from countries with which India might have rupee payment agreements. Iran is mentioned as an example. To the extent this is possible, it reduces the need to pay in scarce dollars for those imports.
And addressing large, persistent trade deficits with specific countries.
Yes, the source flags the significant trade deficit India runs with countries like China as a major drain on dollar reserves. It suggests that identifying and actively working to reduce such large bilateral deficits is crucial for easing the overall pressure on India's current account and, consequently, the rupee.
Finally, the source throws out a potentially bigger, more systemic policy change for consideration.
It does. It suggests that perhaps the time has come for India to seriously consider moving towards full convertibility of the rupee, particularly on the capital account, allowing freer movement of capital both ways.
What's the rationale for that, especially when worried about outflows?
The logic presented is twofold. First, full convertibility could actually encourage greater capital inflows by signaling greater confidence and openness. Second, it might help bring existing underground holdings of foreign currency within India dollars held unofficially into the formal banking system, thereby augmenting the official supply available in the market. The source tentatively suggests that the risk of sudden outflows might be less of a concern when the rupee has already depreciated significantly, making it expensive to take money out. It's presented as a potential bold move to tackle the supply issue head-on.
So the suggested solutions really pivot towards strengthening the fundamentals, boosting exports, attracting long-term investment, and strategically managing imports and trade relationships, potentially even embracing fuller convertibility.
Okay, let's broaden our view now and touch upon some bigger picture concepts and challenges that frame this whole discussion about exchange rates.
Right. Before we do, it's worth noting the source wraps up its analysis of the depreciation situation by acknowledging the difficult times, but also stressing India's underlying strength. Things like high domestic savings rates, abundant resources, substantial foreign exchange reserves at that point, and large domestic demand. It cautions against unwarranted pessimism, often seen in commentary, and emphasizes the need for collective action policy changes, bureaucratic efficiency, restoring faith to achieve both a stable rupee and high economic growth.
That's a good context. Now, one of the fundamental constraints that central banks everywhere face when dealing with exchange rates is captured by this famous concept called the impossible trinity, or sometimes the policy trilemma. Yes, this is a cornerstone idea in international macroeconomics. The source explains it very clearly. A country's central bank simply cannot simultaneously achieve three highly desirable goals. Those goals are: 1. Maintain a specific exchange rate, whether it's rigidly fixed or even just managed within a narrow target band. 2. Allow free capital mobility, meaning capital money can flow easily into and out of the country without major restrictions. 3. Conduct an independent monetary policy, the ability to set domestic interest rates and control the money supply, primarily to achieve domestic objectives like controlling inflation or stimulating growth.
You can't have all three at the same time. You have to choose.
That's the impossible part. The Trinity states you can only achieve at best 2 out of these 3 objectives. You have to sacrifice one. For example, if you want a fixed exchange rate and free capital flow, like Hong Kong's currency board, you give up independent monetary policy. Your interest rates basically have to follow the anchor currency's rates.
Or if you want independent monetary policy and free capital flow, like the US or UK.
Then you have to let your exchange rate float freely, determined by the market. You can't control the rate.
And if you want a fixed rate and independent monetary policy, like China, arguably, for a long time,
then you need capital controls to restrict the free flow of money in and out. The source highlights this as a massive challenge for policymakers, especially during crises, because that's exactly when they might feel the strongest urge to achieve all 3 things simultaneously: stabilize the currency, keep capital flowing, and use monetary policy to fix the domestic economy. But the impossible trinity says you just can't. A choice has to be made.
Wow, it really frames the difficulties central banks face. Okay, another concept we should touch on is how we measure competitiveness beyond just looking at the simple USD-INR rate. The source mentions REER and NEAR.
Right. The bilateral rate, like USD-INR, only tells you about the rupee against one other currency. But India trades with many countries. To get a broader picture of how the rupee's value is changing against all its major trading partners collectively and how that affects overall competitiveness, we need these effective exchange rate indices.
So, what's NEAR?
NEAR stands for Nominal Effective Exchange Rate. It's basically a weighted average of the rupee's exchange rate against a basket of currencies of India's main trading partners. The source mentions India calculates this against a basket of 36 countries, with the weights based on each country's share in India's foreign trade. NEAR gives you an overall sense of whether the rupee is strengthening or weakening against this broad group of currencies based purely on the nominal exchange rates.
Okay, nominal. What about REER?
REER stands for Real Effective Exchange Rate. This is considered a much better indicator, especially for judging changes in export competitiveness over time. Like NEAR, it's a weighted average of the rupee against major trading partners. The source lists a 6-currency basket: USD, pound, euro, yen, HKD, yuan used for this. But the crucial difference is that REER is adjusted for relative inflation between India and those trading partners.
Why is adjusting for inflation so important when thinking about competitiveness?
Because competitiveness isn't just about the nominal exchange rate, it's about the real cost of goods. Imagine the nominal USD-INR rate stays exactly the same. But if inflation in India is running much higher than in the US, then Indian goods are becoming progressively more expensive relative to US goods, even with the stable exchange rate. Your competitiveness is eroding due to domestic price rises.
Ah, I see.
RECARE captures this. It adjusts the nominal rates to account for these inflation differentials. So if India's REER is rising, it generally means that, considering both exchange rate movements and relative price changes, Indian goods are becoming less price competitive compared to its major trading partners. If REER is falling, Indian goods are becoming relatively more price competitive. It's a more sophisticated measure of competitiveness than just NEAR or the bilateral rate.
Very useful distinction. Finally, the source touches upon the relationship, or maybe the disconnect, between exchange rates and purchasing power parity, PPP. It feels like the exchange rate should tell you how much your money can buy abroad, but the source says it often doesn't.
That's the core idea. Theoretically, in a perfect world with completely free trade in all goods and services, exchange rates should adjust until the price of an identical basket of goods is the same in all countries when measured in a common currency. This is the principle of purchasing power parity, PPP. The exchange rate would perfectly reflect the differences in purchasing power between currencies.
But the real world isn't like that.
Not at all. The source points out 2 major reasons why market exchange rates diverge significantly from PPP. First, we don't have perfectly free trade. There are trade restrictions, tariffs, non-tariff barriers, and transportation costs that prevent prices from equalizing perfectly. Second, and perhaps more importantly in today's world, market exchange rates are heavily influenced, often dominated, by factors completely unrelated to trade in goods and services, particularly large international capital flows, investment flows, speculation. These flows can push exchange rates far away from levels that would reflect PPP.
So just because the market exchange rate shows the rupee appreciating sharply against the dollar, it doesn't automatically mean that an Indian visiting the U.S. can suddenly buy way more stuff with their rupees.
No, not necessarily. That market appreciation might be driven entirely by, say, a surge in short-term FPI inflows betting on the Indian stock market, and might have very little to do with the actual relative cost of living or the purchasing power of the rupee versus the dollar for everyday goods and services.
So if the market rate doesn't reflect purchasing power, what is PPP actually used for?
PPP is used as a theoretical adjustment to the market exchange rate, precisely to create a rate that does reflect relative purchasing power. This PPP-adjusted exchange rate is then widely used for making more meaningful international comparisons of economic variables, like comparing the size of different economies, GDP, or comparing average living standards, GDP per capita or GNI per capita.
So when you see international reports comparing country GDPs, they often show figures based on both market exchange rates and PPP rates.
Exactly. The PPP-based figures are generally considered a better measure for comparing real economic size or real living standards across countries because they account for the differences in price levels. The market exchange rate figures can be misleading for this purpose if currencies are significantly overvalued or undervalued relative to their purchasing power.
But just to be clear, even though PPP is used for these comparisons, when you actually need to exchange currency for travel or trade,
You still use the conventional market exchange rate. PPP is a statistical adjustment for comparison. The market rate is what prevails for actual transactions in the foreign exchange market. And the source just adds a historical note that the US dollar became the common currency for these international comparisons, largely because the US was and is the world's largest economy.
wow, okay, we have covered an incredible amount of territory today, really peeling back the layers on exchange rates. We started with the basics, what they are, why they matter, especially in open economies. Then we looked at the different ways rates are set, fixed, floating, managed, and that crucial distinction from convertibility.
hmm We traced India's own fascinating journey, from the post-independence fixed peg to the current managed float system. We dove into the mechanics of supply and demand in the forex market and defined those key terms, appreciation and depreciation.
And then the really meaty part, the impacts. We looked at the complex effects of appreciation, why the RBI intervenes, the challenges of sterilization, the data around whether intervention is always justified, and the importance of looking beyond just price for export competitiveness.
Right. And then the flip side, the impacts of depreciation, particularly the risk of imported inflation and the CAD worsening for India, making it generally unfavorable despite the theoretical export boost. We clarified the difference between market-driven depreciation and policy-driven devaluation.
We then analyzed why the rupee faced those periods of steep depreciation, the role of the chronic CAD, volatile capital flows, and specific global triggers like U.S. policy shifts and speculation. We recapped the severe implications of that slide.
And importantly, we discussed the potential solutions proposed in the source, focusing heavily on addressing the underlying supply-side issues, boosting exports, attracting stable FDI, managing imports smartly, and even considering bolder steps like full convertibility.
Finally, we pulled back to look at those fundamental concepts. The inescapable, impossible trinity facing policymakers. How REAR and NEAR give a better picture of competitiveness than simple rates, and understanding the difference between market exchange rates and the theoretical concept of purchasing power parity used for comparisons.
It really underscores that exchange rates are so much more than just numbers flashing on a screen. They're deeply intertwined with trade, investment, inflation, economic stability, and ultimately the growth prospects of a nation like India. Getting a handle on these dynamics is, I think, essential for understanding our interconnected global economy.
Absolutely. It touches everything, doesn't it? From the price of that imported phone you might be eyeing, to the job security in industries that export, to the overall stability of the economy you live in. So as we wrap up this deep dive, let's leave you with a thought to chew on, something that brings together some of the core tensions we've discussed today. We know about the impossible trinity, that fundamental challenge central banks face, where they can't simultaneously control the exchange rate, have free capital movement, and run an independent monetary policy. They have to choose. And we also know that market exchange rates, left to their own devices, are inherently volatile. They're like constant waves hitting the shore. So the question is this: given these realities, how should an economy like India truly build long-term resilience? What kind of deep structural foundations need to be built, maybe going beyond just the day-to-day firefight of market intervention, so that its exports can genuinely thrive on their own strengths, and the domestic economy can remain stable, less vulnerable to imported inflation or sudden capital outflows, regardless of which way the global currency tide happens to be turning at any given moment?